Okay, so let's give this a rip. Sorry about that. So accounting, a lot of people get nervous when you start talking about accounting. They think it's a bunch of numbers, it's a bunch of math. It's not really designed to be a math class, okay? Accounting, really, the key to it, it's a language. And if we learn some of the terms and what they mean, I think you guys will be fine. It's like learning Spanish or French or any other language. There's just some things that you need to know. And the best way to explain it is, non-accountants use a certain set of words. Accountants use a completely different set of words that are supposed to mean the same thing. And where it gets confusing is there can be multiple words that mean the same thing. Everybody here has heard of something called an income statement, right? Okay. They're referred to as profit and loss or income statement. They mean the same thing. There's some subtle differences which we won't worry about until you get 3 or 4 classes into the future, should you pursue your accounting degree. But for all intents and purposes, those two terms are interchangeable. Okay, so we're going to learn a lot of things like that, and that will get you a long way through the whole accounting scary part, because really that's the only scary part of it. Good? Again, remember, just ask questions as we go. And I will stop and ask you a lot. Anybody have questions? Probably so much so that you'll get tired of hearing it. Good? The other thing I promise I will try and avoid doing is falling off of this step. Because every semester at one point in time it will happen. Okay? So don't fall asleep or you'll miss it. Yes, ma'am?
Can you shut the doors? Okay,
that's the other thing. I always forget that. I'm hot in here, but that's okay. The rule is when I get here it's typically, about 80 in the room. So I'll open both the doors, and as soon as somebody says something, the doors get closed. Good enough? Okay, so the doors get closed. Could somebody grab that back one? There's a little latch up at the top.
Does it go the same the other way around when it gets hot?
Let's just try closing one for now, and we'll go from there.
That's a lot of body.
Good? Yeah. And the AC doesn't seem to come on, it just blows hot air. Everything works about as well as the computer does. And that's the new computer. Okay? All right, so accounting. What is accounting? Anybody want to take a stab at this? I know I've given you no background whatsoever. Anybody want to take a stab at it?
It's a system for reporting income, expenses, try to figure out what the profit is.
You know what? You're right on track. It is a system for recording the transactions of a business. But there's multiple steps. We're going to record them. We're going to classify them. Okay? Not only are we going to write them down so that we have a record forever, but we're going to classify. Now here's where I start teaching you the language. Classify means we're going to take all the transactions that are of a similar type and group them together. That means every time we pay the rent, say we have a business and we rent a building, when we pay the rent, we're going to put it in an account called rent. That's classifying it. When we pay our employees, we're going to put them all together and put it in an account called wages. Now, non-accountants will oftentimes call those groupings buckets or some other similar word. We call them accounts. Okay? Every business has a chart of accounts. A chart of accounts is really just a list of all of your accounts or all of your groupings. All right? And this chart of accounts can be very short or it can be very long, depending on the size and the different things that your business does. Okay? The other thing that I rely on is feedback. If you guys all stare at me, then I don't know if you get it or not, so I keep repeating it. And then it gets really monotonous. So somebody at least just nod your head yes or no. Yes is good, no is good. Something in between is confusing, so don't do that one. Okay? Good. So we're going to take all the transactions of a business, we're going to record them, we're going to classify them, or group them together. We're going to summarize them. So at the end of a month or at the end of a week, say we want to know how we're doing. We take all of those similar events that we classified into an account together, and we're going to total them up. And we're going to create a summary of all the transactions. That's where you generate your income statement, like you mentioned. Okay? Then this is the fun part of accounting. We're going to interpret what that information means. And we're going to communicate that with management. Okay? When I got into accounting long, long ago, it was thought that accountants were these guys who weren't very social and they got stuck in a cubicle somewhere by themselves and they were little hermits that recorded all this stuff, right? That was never true. But as you come into the modern world, more and more emphasis is placed on this communication. Everyone's looking for, what does all the information mean? So to do well as an accountant, they're looking for that person who can translate between the language of accounting and the language of what non-accountants use, everyday speak. Okay? Questions so far? Can you guys hear me in the cheap seats in the back? Good. There is one seat up front if somebody wants to take it. There's a second one over here if you want. Okay? All right. This one's fairly intuitive, at least the first several of them are. Who are the people who use accounting information? Now, the first thing I would think of, it's the owner of the business, right? He wants to know how his company's doing. Am I making money? Am I not making money? How much money do I owe other people? Who owes me money? How much money do I have in the bank? Those are the typical questions. Those are the 5 common questions that you're going to get asked, right? Right out of the gate. The owner walks in and goes, hey, you're the accountant. I got questions for you. What's the first one is he going to ask? Are we making money? Then he wants to know, how much money do I have in the bank? How much money do other people owe me and how much do I owe to others, right? Those are the big questions. So the owner is the primary user of financial information. Commonly, however, companies will go out and they need to borrow money. And you'll go and you'll try and borrow money from a bank. And what does the bank want to see if you borrow money? They want to see your financial information. They want to know if you can pay them back, right? So the bank's going to be a big user of it. Supplier, someone who's selling you product. Why would they want to know what your financial information looks like?
Make sure you can pay for it.
They're in essence lending you money as well. They're giving you what's called terms. They're going to let you sign for something and pay them in 30 days or maybe 60 days. They're lending you money basically, and they want to know if they're going to get paid or not. Investors. Who are investors? Okay, it could be a lot of people. In a small company, an owner, it might just be one guy. This is my company, I started it, I put all the money in, it's mine. Now let's take that to an extreme. Intel, anybody heard of them? Okay. I just picked them at random. We could have said Coca-Cola. How many people own Intel? Is it one guy?
No.
It's a whole bunch of people, and they sell stock on a stock exchange, right? And you can buy or sell shares of it all day long, any day. So those are investors. They're investing in the company, and they are technically also owners. But it's a different kind of company. This one has many owners. Typically, they're corporations. And a single owner is just a small sole proprietor. We in this class are going to focus on the sole proprietor, the one guy. Okay?
So those differences between owners are?
We'll get into that in a minute. But yes, that will come up. It's going to come down to ownership rights and limited liability. Regulatory agencies are users of financial information. Who is a regulatory agency?
IRS.
The IRS, sort of, yes?
Granting government agencies who grant you money.
If you're a nonprofit, it could be.
SEC.
The SEC, who said that? You nailed it. Okay, if you're Intel and you're trading your stock on a stock exchange, you're required to file all of your financial information and disclose a whole bunch of data to the SEC. You have to make all of your information about your company public so that the little guy, the investor, can make an informed decision. Okay, that's the best example. Tax authorities. This is the IRS sort of thing. They want to come in and see if you owe money, or the state of California. Have you paid all of your taxes? Customers. Did anybody think that one up? Why would customers want to know your financial position?
I want to know if you're going to be around, buy something.
He nailed it. Think about long-term stuff. I want you to come in and build if I'm Google and I want to hire somebody to come in and build a campus facility for me, 3 or 4 buildings where all my people are going to work with a big garden in the middle and all that, it's going to take how long to build that? Year, 2, maybe 3. I want to know if you're going to be around in 2 years to finish it, don't I? If I give you all this money now, are you going to actually be around to build the thing? So yes, your customers may even want to know. Good? Okay. All these people want to make intelligent decisions about the company. The owner wants to know how to run the company. Bankers, suppliers, investors all want to know if they should invest in the company. Tax authorities want to know if they've sucked enough lifeblood out of you. Right? Okay. If you're in this class, some people are in this class because they have their own business, or you're thinking about getting into accounting, or it's a requirement to do something else. All those things are great. But if you're in this because you're thinking about getting into accounting long term, I just want to cover a couple things. If you get into accounting as a career, there's several ways to go. Public accounting. Has anybody heard of this? These are the guys, CPAs. They're the only ones who are authorized and recognized to audit financial statements of big companies. That way, the audit is a required element from the SEC to be able to trade your stock on an exchange. So that's really what these guys do. Managerial accounting, these are people who go in and work at a company, whether it be small, large, what have you. And they are gathering all the information, recording the transactions, interpreting it, generating reports for management so they can decide how to run the company and make intelligent decisions about it. Governmental accounting. I know we don't think of them as a business, but governments have to keep records just like any other business. How much money did they bring in through taxes? How much are they spending on the different programs? All of that. So there are accountants in government, whether it be federal, state, county, city. So there's lots of accountants working for the government. We kind of touched on this, but certified public accountants perform the required audits. A lot of banks require audits. The SEC requires it for publicly traded companies. But if you borrow a lot of money from a bank, say several $1 million, they may require you to submit audited financial statements. It just gives them an extra level of assurance that someone has looked at it and that the information reported in it is correct. And that's what CPAs do. They look through and check the transactions, not all of them, but on a test basis, and they issue a statement that says, I believe that these financial statements fairly present the financial position of this company. And that's all they do. They express an opinion. And all of their work comes down to one-page letter that it gets attached to the front of somebody's financial statement that says, in my opinion, these statements are okay. Or, no, these statements are not okay. All right? A lot of times, as a result of having in-depth knowledge of your company, they'll do your tax returns and do some tax planning for you. And they will do consulting services. They'll do management work, like the management accountants do that I mentioned a minute ago. But they'll come in and do it on a consultant basis, temporary sort of thing. or they'll bring in technical expertise that the company doesn't have. Good. Can I segue for a moment? I promise you that chapters 1 and 2 are the ones that deal with all of this stuff that you just have to kind of memorize. Then we get into the fun of the class. Okay, so you're going to have to just kind of bear with me tonight. And unfortunately, because we missed a week from the holiday, I have to kind of charge through this tonight. I can't kind of stretch it out and feed you a little fun and a little bit of this and a little fun and a little bit of this. We're going to just power through this and get it all behind us. Everybody okay with that? Good. Besides, there's a lot of people in the room, and if I sit here and call Ferris Bueller's name a number of times, it'll bore a few people and seats will empty out. Good? Okay. If you get that joke. Managerial accountants, management accountants, they work in industry. These are guys who not only record the day-to-day transactions, create the financial statements, report to management, they do budgeting work, they do planning work. Like I said, they prepare the financial statements, direct the accounting function. If you get high enough up and you get to be one of the senior accountants, you get to set policy and procedure. Okay, not just for accounting, but it'll affect a lot of other people as well. For example, like when do we calculate the bonuses for the salespeople? Well, the accountants pretty much have a say in setting the policy on that. It affects the entire company, not just their own little department. Good? All right. Government accounting. They record the transactions, categorize them, create the financial statements, but they can work for federal, state, local governments. Here's some fun things, though, that people don't think about. Anybody know who the GAO is? Governmental Accounting Office. They have their own great big group of accountants that kind of oversee all of the other governmental accountants. The IRS, full of accountants. That seems like a logical place where accountants would go, right? From my experience in dealing with these guys, they don't have as many trained accountants as you would think. They get a lot of people and they train them internally as opposed to professionally. Here's one people don't think about. The FBI and the CIA are great career paths for accountants. Career paths for accountants. The FBI hires accountants all the time. Anybody guess why? What?
Scams.
Yeah, financial scams, fraud, money laundering, drug trafficking. Somebody's got to hide all the money, right? How did they get Al Capone?
Tax evasion.
Tax evasion, bingo. They couldn't get him for any criminal activity, so they went after his taxes, right? So lots of opportunities. All right, here's a new word. GAAP, G-A-A-P. It stands for Generally Accepted Accounting Principles. In its most simplest form, these are the rules that we follow to perform the accounting function. I'm going to throw all the slides up here just because I like to approach them in a different order. Oh well. Long ago, accountants have been around forever. Accountants were trained to go in, look at a company's records, and make an opinion. In my opinion, these financial statements are accurate and fairly present the situation of this company. Or it does not. Now, none of you are old enough to remember this, including myself, but back in the 20s, there was a lot of activity and investment in the stock market by all kinds of people. Small people, people with a lot of money. What happened at the end of the 20s? There was a big stock market crash. Okay? When that happened, and the whole country dropped into a depression, the accountants got together and said, hey, we're in deep doo-doo. We used to be the guys that people relied on, to express an opinion on these companies, and they invested based on that. And the whole market just tanked. And basically all of our opinions right now don't mean bubkiss to anybody. And part of the problem was there was no common set of rules. People were presenting financial information differently because there was no combined guide on how to do it. So I would present it one way because I thought that that would correctly share the information with others. Someone else might take a different approach to highlight certain information over other information. And that'll make more sense as we go through this class. But in the 30s, all the accountants got together, and it's a group called the AICPA, American Institute of Certified Public Accountants, and they created this set of rules, GAAP, so that everyone followed the same set of rules and financial statements were prepared the same way. So that when you read one set of financial statements, you could now read another set of financial statements, and you could compare them from one to the other, because they were created under this set of rules. Before, that wasn't necessarily the case. So what you got is a set of rules where the financials of Company A and Company B are comparable, plus, under the rules, you don't change from year 1 to year 2 to year 3 the order that you present things in. So they're comparable through time and across different companies. So it added a lot of value to the statements. And the AICPA created these generally accepted accounting principles and maintained them and added to them until the early 70s, when they created the FASB, Financial Accounting Standards Board. And the Financial Accounting Standards Board are the guys who now are responsible for creating and maintaining GAAP. Good? Too much information? Maybe. Just because I know it, I can repeat it, right? It'd be a ton of fun to get that category on Jeopardy. So the FASB now works with the SEC to create these rules and maintain GAAP. Okay? And there's about, I lost track, there's about 170 some of these. Does anybody know? They're adding to them all the time. When I finished my formal education years ago, there were 109. And there's 100. So from 1934 to about 1990, there were 109 of them. And from 1990 to today, there's another 60-some. So the speed with which they're coming out has picked up considerably because of all the crises and things that are going on, right? They think if you legislate everything, you can solve the problem. All right. They're comparable to other companies. Banks require it. We've kind of covered a lot of this already. Questions? No? All right. Okay. So, as we start talking about accounting and recording transactions, which is going to come very quickly here, you need to be aware that there are different kinds of companies. And this covers the question you asked earlier. There are several different types of business entities that exist, and they all have different benefits and drawbacks. A sole proprietorship is the simplest one to create. It consists of going, hey, I got a great idea. I'm going into business. And you're done. You've just created your sole proprietorship. I'm the only owner, and I'm going to create a business, whatever type of business you may decide. Let's say I'm going to teach diving lessons, okay? And bang, I'm in business. Here we go. Put an ad in the paper, right? A partnership is where two guys are sitting at a table together and they go, hey, we have a great idea together. So instead of there being one owner, there are two. And they clap their hands together and say, hey, we're going to go into business together. All right? And that's really the only difference. Corporation is a different animal. A corporation is an entity where you're allowed to sell stock and therefore have many owners. Not just one. You could have, I don't know, how many people do you think own GM stock? Probably quite a few, right?
All of us.
All of you? Okay. No, that's the old GM, which isn't worth anything. All right. We don't want to get started on that. I have a definite opinion about that one. So a corporation is, a sole proprietor is a person goes into business. That person is a person, right? A partnership is two persons who go into business. A corporation, you have to go down to the state that you want to do business in and tell them, hey, I want to be a corporation, fill out some paperwork and comply with some rules and pay some taxes. And in exchange for complying with all these rules, they make the corporation a person. So the corporation is its own person. In a sole proprietor, if the owner dies, does the business continue? No. In a partnership, if the owners die, does the business continue? No. In a corporation, if one of the owners dies, and there are thousands of them, does the business go on? Yes. The owners get together at what's called a shareholders meeting, and they elect a board to run the company. So a group of people run the company, and you've got continuity of life because there's so many people involved. There isn't one key. It's not like having a three-legged chair and you take one of the legs away, right? It falls over. So you've got many legs on the chair, and if you take one away, it's going to be okay. An LLC is a limited liability company which takes on aspects of partnership and corporation. And the reason it was invented was to create a scenario of limited liability for these other two types of people to be the same as a corporation. Does anybody know what I mean by limited liability?
So, a limited liability for a partnership would be if the partners aren't responsible for each other. Is that sort of what it is?
You're on the right track.
So, like if I don't really know.
Let me make it real concise. Okay? If I go into business and I'm going to be a landscaper, and I go buy a truck and a lawnmower and a rake. It's all I need, right? And I'm driving down Soquel Avenue, and one of you students crosses the street against the red light, and I run you over. You guys can sue me and take the lawnmower, take the truck, take the rake, take my house, take my retirement plan, everything. That's unlimited liability. Sole proprietors and partners have unlimited liability, meaning that if you get sued, they can go after assets, both the company's assets and your own personal assets. In a corporation, if I'm a landscaper but I'm a corporation and I get sued, they can take the truck, the lawnmower, and the rake, but that's where it stops. They can't come after anymore. My personal stuff. Okay? And a limited liability company takes these partnership type entities and gives them that limited liability. Yes, ma'am?
What about the LLP?
That's a limited liability partnership, same sort of thing.
Same thing, but applies to partnership.
Yeah, for purposes of this class, close enough to the same thing. Yes?
Why wouldn't any sole proprietor or partnership want to be LLC?
Because you have to jump through a lot of hoops. You're basically doing all the same paperwork and applying with the state and paying these taxes. They have what's called minimum tax that you're going to pay anyway just for the privilege of being able to call yourself an LLC. So a lot of people don't do it. Is it a good thing? Probably. I would recommend it, but some people don't because they don't want to do all of the requirement. Yes?
I was saying, what about the issue of taxes?
Well, I think we'll get to that in another slide, but just so you know, a sole proprietor, since he's an individual, pays the taxes of the business when he files his own 1040, when he files his own individual tax return. Okay? A partnership has a partnership tax return, but the partners pay the tax themselves out of their own pocket. It gets reported on their 1040, and they pay the tax there. A corporation pays tax on its own because it's an entity. All right? Now, the downside to a corporation is if a corporation makes a profit, it pays tax on it. And then when it gives, it declares a dividend, meaning it gives some of that profit to the owners, the owner is then taxed on it again. So it gets taxed twice. It's called double taxation. And that's part of the downside of being a corporation, and that's part of why some people don't do it.
You could be a sub S.
You could be an S Corp, which is a small corporation. You're only allowed 75 shareholders, I believe it is, which is a lot, plenty. And then you're treated as the tax is reported on the owner's tax return and he pays it. So, but there's some other hoops you got to jump through on an S Corp. Yes, did you have a hand? Okay. Other questions? Answers? Moving right along. All right. Here is one of the key elements of accounting. This is the separate entity assumption. If you're a sole proprietor, let's do the simple one here. I decide I want to be a landscaper, right? And I keep a set of records for my business. And I pay for the gas on the truck and the insurance on the truck, and I bought the lawnmower and I bought the rake. And then in the same records, I'm all of a sudden recording when I go to Safeway to buy groceries and when I make my house payment. I'm mixing my personal business with the business. And then when you do an income statement and you try and show that you've got a deduction for paying the house payment, no. You always keep those two entities separate. Your personal stuff is kept separate from the business transactions so that you can report a clean set of financial statements for just the business. Okay? This is one of the big challenges with small companies. You know, they don't have a lot of accounting expertise, so they'll go down to a bank and apply for a loan, and the banker will cringe because they have financial statements that include all of their personal activity with their business activity. And it's really hard to tell if they're making money or not with all of that going on. It clouds the issue. It doesn't give you a clear understanding of how the business is doing. And as accountants, that's what we are really trying to do, is we're trying to create a clear understanding of how the business is doing. So you've got to follow the separate entity assumption here. Okay? Good? There will be homework questions on it, but yes.
Yeah, except unfortunately, a lot of small business owners think the only reason to do bookkeeping is to prepare a tax return. The more expenses, the better. So. Yeah, exactly. I get that.
Other questions? Okay, so just to recap real quick. Sole proprietor, owned by one person. The business ends when the owner dies. The taxes are paid on the owner's individual return. The owner has unlimited liability. Any debts of the company, the debtor can come get money from the owner, even if it's not company money. Okay? Partnership, there's two or more people. There has to be more than one, but there can be thousands. The partners are both have unlimited liability, and the business is over when 50% or more of the owners, when the ownership changes possession. What do we mean by ownership changes possession? It can be sold to someone else, or it's a polite way of saying somebody died. Okay? All right. They file a separate tax return, but the owners end up reporting the taxes on their individual returns, which is called a 1040. Good? Okay. A corporation is recognized as a separate legal entity. It's treated as a person. It can be sued. It can sue others, just like a person. Stockholders, the owners are the stockholders. The business does not end until it goes into bankruptcy, like the old GM, or you go down to the state and Remember, when you form a corporation, you got to go to the state and fill out paperwork and jump through these hoops. If you want to end a corporation that isn't bankrupt, you have to go down to the state, fill out a bunch of paperwork, prove that you've paid all your taxes, jump through a bunch of hoops. And they'll say, okay, you're not a company anymore, you're not a corporation, and then it's over. But you can't just stop, you have to go through that process. If the company gets sued or goes out of business or bankrupt, the most you can lose is how much ever you spent to buy the stock. They can't come after your house or your car or any of that. Okay? Good? Somebody nod yes or no. Okay. Yes, ma'am.
How do you begin a corporation? I'm always hearing small businesses say, we need to incorporate. Do you, let's say a bunch of you pool your money, you stockholders in that corporation.
Yes.
Do you have to open it onto the market, or can you stay?
You do not, no. There are many, many, many companies that are corporations that are privately held. You know, there's one shareholder or just a family holds all the stock. Far more than there are publicly traded. And really, the reason people are publicly traded is to raise capital. Right? I can be a sole proprietor, but I have to come up with all the money to buy that truck and the lawnmower out of my pocket. Right? To be a partnership, then two of us can come up with money. Maybe we can buy 2 trucks and a nicer lawnmower. Right? But if I want to build Teslas in Fremont, and I got to buy that building, you become a corporation and you sell stock in what's called an initial public offering, and you raise capital and you sell them a percentage of the company in exchange for the money. And you can raise millions of dollars. Ask that Mark Zuckerberg guy. Okay? Got it. Limited liability, can have 1 or more partners. They can elect to be treated as a partnership or corporation for tax purposes. Okay? But it gets the limited liability. Questions on any of that before I move on? Yes, ma'am.
So you're talking about for the LLC that it can either be a partnership or a corporation? Are you talking about it can either, for taxes, it can either be paid out of your own pocket or as a separate entity?
Yes, it can pay the tax directly, or you can opt to report it on the individual returns of the owners and they pay the tax. Okay? And you're assuming that the company would give the owners the money in a distribution to be able to pay the tax. Okay?
I usually do that based on the size of the...
Making this decision?
Yeah.
No, I would... There are other tax considerations that come into play there, and a lot of it has to do with the tax effects on the owners and the other things they have going on in their life. Okay? So you really have to look at it kind of on a case by case. But if you're going to go down this path, why don't you just go for an S-corp sort of thing, you know? So a lot of them end up over here. But depends on size again. Remember, an S-corp, I believe it's 75 shareholders. They were talking about raising it to 100, but I think it's still 75. So think about it. If you have a successful company, and it's me and my wife, and we leave the stock to our 7 kids, and they have 7 kids each, and they leave it. How many? You start to have how many people, and you can have too many shareholders all of a sudden. And then your whole S election blows up, and you've got a big problem. So, yes?
Just thinking of a company like Trader Joe's, it's privately owned.
Yes?
Is there a partnership?
Trader Joe's is a partnership. Is that a question or a statement? Because I'm not sure.
They're generating so much money. I mean, where does the capital come from to open new stores and stuff if they're not a corporation?
Are you sure?
They're not positive. I heard they're privately owned.
Well, they're probably a corporation, but they have...
They're foreign.
Okay, you can have a limited number of owners. You could have, 1 stockholder or 4 stockholders. And the other thing you can do is, you're a person as a corporation. Go borrow the money from someone. A bank, the Germans. The Germans like lending people money. Ask Greece. Right? Can't wait till that bill comes due. You're going to have the Dahmer Chrysler logo on the Pantheon, Parthenon. Got to get the right one. Okay, you had a question in the back? No? Okay. Anybody else? Okay. We good so far? And this is the boring stuff, remember?